Every video in this course has covered a specific financial tool, account type, or system. This video is different. It covers the behavioral and psychological layer that determines whether someone who understands all of those tools actually uses them consistently over time, and whether the financial decisions they make across years and decades compound into meaningful outcomes. The gap between financial knowledge and financial results is real and well documented. It is not primarily a gap in information. It is a gap in behavior, and behavior is shaped by habits, mindset, and the way someone relates to money at a foundational level. This video addresses that layer directly. The first concept worth establishing is the difference between income and wealth. These two things are frequently conflated, and the conflation leads to a distorted picture of what financial success actually looks like. Income is the rate at which money flows into your life. Wealth is the accumulation of assets minus liabilities, what you own minus what you owe. A person with a high income and high spending has cash flow, but may have minimal wealth. A person with a moderate income and disciplined saving and investing over time can build substantial wealth. The relationship between income and wealth is mediated entirely by behavior, specifically by the gap between what you earn and what you spend, called the savings rate, and what you do with that gap. Income provides the raw material. Wealth is built from what you do with it. The savings rate is the most important variable in wealth building for most people, particularly in the early years before investment returns become large enough to be significant contributors to net worth growth. A person earning $50,000 with a 20% savings rate is saving $10,000 per year. A person earning $100,000 with a 5% savings rate is saving $5,000 per year. The lower earner is building wealth at twice the annual rate of the higher earner, not because of income, but because of the gap between income and spending. This arithmetic does not diminish the importance of growing your income. Higher income amplifies the effect of a strong savings rate, but it illustrates that savings rate is the primary lever available to most people, and it is a lever entirely within their control. Lifestyle inflation is the most common force that suppresses savings rates over time. Lifestyle inflation refers to the tendency for spending to rise in proportion to income as income increases. When someone receives a raise, a promotion, or a new higher-paying job, the natural response is to upgrade expenses in ways that feel commensurate with a new income level. A nicer apartment, a newer car, more frequent dining out, more expensive vacations. Each individual upgrade is reasonable in isolation. The cumulative effect is that spending tracks income closely, the savings rate stays low, and wealth accumulation proceeds slowly despite rising earnings. The people who build wealth most effectively are not necessarily those with the highest incomes. They are the ones who consistently allow a meaningful gap between income and spending to persist as income grows, directing a significant portion of income increases into savings and investments rather than consumption. The concept most directly opposed to lifestyle inflation is often called paying yourself first, which was introduced in the budgeting module, but deserves emphasis here in the context of long-term wealth building. Paying yourself first means directing a defined percentage of every paycheck to savings and investments before any spending decisions are made. The transfer happens automatically on payday before the money enters the account you use for daily spending. What remains after the transfer is the budget you have available. When income increases, the automatic transfer amount increases proportionally, so the savings rate is maintained rather than absorbed by higher spending. This single structural change in how money flows through your financial system has more impact on long-term wealth outcomes than almost any other single behavioral adjustment. The psychological relationship most people have with money is shaped significantly by the environment they grew up in, the messages about money they absorbed from family and culture, and the emotional associations that develop through early financial experiences. Money avoidance, the tendency to disengage from financial topics because they produce anxiety, is one of the most common patterns and one of the most financially damaging. People who avoid thinking about money, opening financial statements, checking account balances, or engaging with financial decisions do not eliminate financial problems by avoiding them. They allow those problems to grow unexamined until they become crises. Financial awareness, meaning the regular, non-anxious habit of knowing where you stand financially, is the behavioral prerequisite for everything else in this course. Building financial awareness as a habit means establishing a regular cadence of financial review. A weekly check-in of 5 to 10 minutes to review account balances, recent transactions, and any upcoming bills builds the habit of staying connected to your financial reality. A monthly review of spending against budget categories identifies patterns and variances worth addressing. A quarterly review of net worth, investment balances, and progress towards specific financial goals provides a longer-term perspective on trajectory. An annual review covers insurance coverage, beneficiary designations, tax withholding, and any major financial decisions anticipated in the coming year. None of these reviews needs to be elaborate or time-consuming. The value is in the regularity, which keeps financial awareness current rather than allowing months or years to pass without examining the picture. Goal setting in the financial context is most effective when goals are specific and tied to concrete numbers and timelines. A goal of saving more money is not actionable. A goal of reaching a fully funded emergency fund of $9,000 within 12 months by saving $750 per month is specific, measurable, and has a defined endpoint. When goals are concrete, the decisions required to achieve them are identifiable. You know whether your current savings rate is sufficient. You know what needs to change if it is not. Vague aspirational goals produce vague effort. Specific quantified goals with timelines produce specific action. The distinction between short-term thinking and long-term thinking is one of the most consequential differences in financial outcomes across individuals. Short-term financial thinking optimizes for immediate consumption and immediate comfort. Long-term thinking accepts present constraints in exchange for future outcomes that are materially better. The challenge is that the future rewards of long-term financial behavior are invisible and abstract in the present, while the present costs are concrete and immediate. Declining to spend money on something desirable today requires tolerating the absence of that thing now for a benefit that arrives years or decades in the future. This is psychologically difficult, and it is why long-term financial discipline is a habit that requires deliberate cultivation rather than one that emerges naturally. One practical tool for strengthening long-term thinking is calculating the opportunity cost of discretionary spending in investment terms. A $500 discretionary purchase today, invested instead in a portfolio earning 8% annually for 30 years, would grow to approximately $5,000. This calculation does not mean every discretionary purchase is irrational. It means that large discretionary purchases carry a hidden cost in foregone future wealth that is rarely made explicit at the point of decision. Running this calculation occasionally for significant purchases builds the habit of connecting present spending decisions to their long-term financial consequences. Framing money in terms of time rather than nominal amounts is another perspective shift that many people find clarifying. If your after-tax hourly earnings are $25, a $200 purchase costs you 8 hours of your working time. Evaluating purchases in terms of the labor they represent rather than the nominal dollar amount creates a different relationship with spending that can help calibrate decisions more naturally against the actual cost in terms of your time and effort. The comparison trap, meaning the tendency to calibrate your own spending and lifestyle against what you observe others doing, is a significant driver of lifestyle inflation and a source of financial decisions that do not reflect your own genuine priorities. Visible consumption, the cars people drive, the homes they live in, the vacations they post about, reflects only the spending side of someone's financial life. It says nothing about their savings rate, their debt load, their investment balances, or their net worth. Many people who appear financially successful by observable consumption metrics are carrying significant debt to finance that appearance. The standard you are actually comparing yourself to is a surface, not a financial reality, and making spending decisions to keep pace with a surplus leads to financial outcomes that are worse than your income would otherwise support. Building financial habits is subject to the same psychological dynamics that govern habit formation in any domain. Habits that are simple, automatic, and tied to existing routines are more likely to persist than habits that require ongoing willpower and deliberate effort. Automating savings transfers, automating investment contributions, automating bill payments, and automating retirement contributions removes the need to make the same good decision repeatedly. The decision is made once at the system design level, and then executed automatically without ongoing deliberation. This is the structural advantage of financial automation. It moves wealth-building behavior out of the willpower domain, where it is subject to fatigue and competing priorities, and into the system domain, where it happens by default. The mindset that produces the most reliable long-term financial outcomes is not one of deprivation or rigid restriction. It is one of intentionality. Spending that is deliberately chosen in alignment with genuine priorities is sustainable and satisfying. Spending that is reactive, habitual, or driven by social comparison tends to leave people financially worse off without feeling correspondingly more fulfilled. The financial behaviors this course covers, budgeting, saving, investing, managing debt, using tax-advantaged accounts, maximizing employer benefits, are not ends in themselves. They are instruments for building a financial life that gives you options, security, and the ability to make choices based on what genuinely matters to you rather than on what your financial constraints force you into. That is what financial freedom actually means in practical terms, and it is built through consistent behavior applied over time, not through any single decision or financial product.